record on this computer. All right, so today I'm going to go over liquidity. I mentioned it in pretty much all the previous Zooms. I touched on it on the entries which you can get. And today we're just going to focus on that mainly, how you can enter on liquidity, where to target, because I see a lot of people, they enter the trades and their TP never gets hit. So you just got to know where price wants to come to before reversing and how to actually use liquidity. Firstly, to get the entries, where price can act as like a roadblock. So you see here today, when price came into this area, we had all these wicks, this like roadblock. So say you're in short positions up here, and your target was down here, you'd have like an area marked out like this area here as like a roadblock area. So if price starts rejecting from this area, that's when you can look to either close the trade as it starts to come back up, or you could just hold to the TP. But these liquidity areas can act as areas of reversal as well. And I think a lot of people in the Discord were actually in short positions here today. No, long positions, even long positions. So they were buying around this area, up to like 1827, 1830 area. And they were like caught in liquidity, because with gold at 1:30 to 2 o'clock, that's when you'll see all the manipulation. So that's when you'll see like these big candles, these big wicks coming into New York session at 2. Also, make sure your chart is on UTC +1, the London one. So then you can mark the New York and London, which I talk about, because I think it's set to something else automatically. So you can look out for like 1400, 1330 and areas like that where you can see this movement on gold. But the reason I had this trend line drawn out is it acts as liquidity, because if you think about it, there's 95% or 99% of traders actually fail. And that percentage of traders, they're like retail traders. Because technically we're retail traders, but we trade institutionally. So we trade against the retail traders. So what you have is you have this trend line moving down. So the retail, they're seeing this descending channel. And when they get like, if we adjust it slightly like this, so you have the 1 tap, 2 tap, maybe you have the 3rd tap here, they're looking to sell, and they always put their stop loss just above. So if price breaks above the trend line, then they're out of the trade. So what is above this level now? We've got all this liquidity. So we've got money above here now, which can be grabbed before we make the original move. Because say they see the break of this trend line, they're now looking for buys. But because we know the price has just grabbed this liquidity up here, and you also have liquidity in this area. Liquidity, the easiest way to spot it is you have like a lot of wicks. So like down in this area down here. So you see if we line this up here, wick, wicks, wicks, wicks. And what did price do? It came down before the news, grabbed the liquidity below the area, and then price moved in the original direction. But say you're a retail trader, they see the big bearish candle moving down, they're looking to short, because price is now technically broken their so-called support area. So you need to be careful of these areas, because like we see here today, this trend line was acting as a liquidity grab. So what did price do? It started respecting it still, and then 1 o'clock, price came up. They were thinking, oh, we're in so much loss now. We've got to close out our positions, close out our sales. Now they're looking to enter buy positions. So what we're looking to do is now sell. It's hard to get an entry on this in this scenario here. But you literally could have looked, if we remove this here, make it easier to see. So if you look back, we've got wicks in the area. This is the liquidity zone. Price came in. You could say 50% of the liquidity zone was filled on this wick. Could have got an entry here. Stops, you could have had tight stops just above this wick here. So if we clear this wick, then we'll go to the next liquidity, which, as you see, you could have this imbalance here, which is yet to be filled, this order block, or you could even have the weekly liquidity, which, as we remember, this weekly zone here, this whole area is acting as a liquidity. So when we tapped into it, that's when we did have our drop, because this whole weekly zone where we've had these wicks, what did price have to do? Had to come up to test the liquidity before then creating the drop, which we did have a whole week of bearish price action after we had this liquidity grab pretty much into the area, and then we dropped. Let's go back to the 30-minute now. They would have been stopped out, the retail traders. We would have entered up here. You know, we could have even got a fib entry maybe. If we draw the fib across. Yeah, exactly. Perfect. So if we draw this across, so like that. So you've got the liquidity. You could have even entered on this first liquidity area here, but then we did have the descending trend line, which, you know, retail, they were loving this. They were thinking, oh, we're going to break out to the downside. We're going to sell on the third tap. They've been stopped out by this liquidity grab. We've entered on it. You could have got entry here. You could have got re-entry here on this liquidity grab. Targets, you could have a first target here, this imbalance, technically imbalance fill, or next target, you could be targeting this small order block down here, or this imbalance fill, or to fill this wick, which was also a 130 news manipulation. So let's say you're just targeting the imbalance, you know, you got 1 to 10 of this area. But say you were trading the trend line and you're waiting for a break and retest of the trend line like retail would have done, they would have got in here. Maybe they would have had their stops above this area, and say they're targeting this area down here now, they got 1 to 5. So half the risk to reward, they've missed half the move, and they've been stopped out on this first one here. They've waited for the retest of the trend of the channel. So that 5% is actually only 4% because they would have got stopped out when it entered the third tap on the descending channel. So we also had the exact same thing happen if we just get rid of this here. So the exact same thing on gold. You know, a lot of people say in trading, history repeats itself, and that is 100% true, because you see this whole thing here happened identically here. So we had this big push up. Wait, would that have been NFP maybe? Yeah, that was NFP. So we had the news push up. So NFP push price up into this weekly liquidity zone. And then after it tapped into the liquidity, after the news push, what did price then do? It created this descending trend downwards, very steep move. And then the same thing that happened on gold today. We had the same thing here. Price then broke out, and then we did have a big drop. So this happens quite a lot. You see these trend lines get violated, as they'd say. And this is where you can look for your entries, because you want to be targeting their stop loss. So you want to be entering sells when they're buying. Because obviously, if we're trading the same direction as the 99% of losing traders, we're going to lose too. Obviously, they'll be right a few times, but majority of the times they're wrong. Otherwise, they'd be winning traders. So if we look on this one, how you would have got an entry. So with this one, let me go on the 4 hour. So the way you could have got an entry, you could have said this right here, the last bullish candle. You could say this is a tiny order block in this area, which then tapped perfectly, then drop. But I ideally would have got an entry actually on this top area here, because if we see in this weekly liquidity zone, which we had down here along this line, we do have areas on the 4 hour. So this whole area up here is liquidity. You could say it's resistance. You got 1, 2, 3, 4, 5. And then this was the 6th or 7th tap even into this area. And when there's a so-called resistance, this is also a liquidity area. Liquidity also known as like supply, demand, areas like that, where there are a lot of stop losses above and below the area. So if we go back down to the 30-minute, This example, I don't think you'll see it very often compared to the example I'm going to show next, because you do need to have like that initial push to then create this downwards consolidation. You see it a lot after news as well. So you have the news push up, and then usually the day after we have a big move, that's when price slowly moves in one direction, and you can't really get an entry on it because it's just moving so slow. It moves up, down, up, down, up, down, but gradually moving to the downside. Same thing here, obviously. And this usually only happens after the big moves. So you don't want to be stuck in a situation where you think, oh, the dollar's now strong. That means gold's going to carry on dropping. Where in fact, price has literally corrected the whole NFP move in pretty much, how many days? 2 days of actual trading after the move happened. Because obviously we had the weekend, and then price opened here, and then it corrected price in the first 2 days of opening. And then the same here, we've had the news, and the first 2 days of opening, we've got the first day now after the news, and price has almost corrected the whole move already. So if we actually look back at another example here, when price is like this is literally all liquidity. So if we go back to like here, let's say, so I think I mentioned it in another Zoom about QMLs. You can use these. So it's pretty much an institutional head and shoulders. So price come up, create the first shoulder, like this, the first shoulder, the head. And then here, what we've done is we have broken the bottom neckline to create a new low. And this is obviously liquidity in this area. But also up here is liquidity. So this is when you can look to take sales from. And as you see, what did price do? Came up, tapped the area. And this is where anywhere in this area here is where you can look for sell to the downside. So if we actually box the area off, so let's say this area here, if we box that off, you could have got the entry here. But if we're looking, we want price to grab this liquidity because we've had these small moves, but this whole area here is acting as liquidity. So you want a further grab of this area. So if we might get it. So that this is where you get the grab. So it's mostly seen when you have a closure in a tweezer top. So like I mentioned in another video, tweezer tops work perfectly on gold. So in this area here, what do we have? We have wick, wicks. And what do we need to do? We need to grab this liquidity. So you could say, this is another perfect example actually. This area here is liquidity, grab, tweezer top. We've closed above, tweezer top, drop. We've got all this liquidity above, tweezer top, drop. So when you have all these wicks like this, you will most likely see price come up, create this tweezer top formation with the close above. So a lot of people will be saying, all right, so let's say we go back, let's go back to here. Say you were a retail trader, you'd see this. You've got this resistance area, you've got price break it, heavy rejection, close above this retail resistance turns support. They're buying, 100% they're buying here. So what do we look to do? We look to sell, and their price moves down to the previous liquidity zone, which also imbalance here, yet to be filled on a higher time frame. And now what we're looking to do is for price, we now created the QML. You could have got the entry, but the thing with the QML is you usually like to have your stops around this area here above the head. And the first target is usually the for the right shoulder. So you've got to be a bit careful, especially with having your stop loss below an imbalance area. You see a lot of times you'll be in a trade, you've got perfect entry, but then price comes up and then moves in your direction. So you'll be in profit, maybe it'll come up and then go in your direction. And this is literally because you got an imbalance that has to be filled before price drops down. So the analysis isn't wrong. You just got the stop loss in the wrong place. You just got to be wary of these imbalance areas because they can come back to fill the full imbalance and then drop. Yeah, the same thing here. If we're looking to enter, you see we're generating this liquidity, this sideways movement, and then we have the close, and this is where you can enter. You see my entry, if we look, it's on this wick back up. There we go. And this was literally, I think I missed this original move here. So then I had to get in pretty much late. And you could say we had an order block, price came back, filled the order block, and then we dropped. If we look what happened with price, then came back down. And what do we have below here? We had liquidity. We had wicks that have been left behind. So what did we do? Dropped, grabbed the liquidity, came right the way back up. And then we started the whole process again. And if we play price on, if we look for another example, and then once you caught these shorts, you could have caught the buys as well, because this area here, this is all liquidity. And when prices filled this imbalance, tapped in the order block, could have got the buys. And where would you have targeted? You would have targeted the weekly liquidity zone, which, as you see, pretty much tapped to the pip. You know, you got like 2 pips away from the zone being hit. Let me see if I can find another example of this. It does happen a lot on gold, especially pairs that have the big move and then they have like a consolidation phase after. That happens perfectly on pairs like that. Now, if we look back in this zone, for another example, yeah, so this is another example here. So this area, we had this big push up, and then we had this slow area where we couldn't break above. We were creating wicks in the area. And what does price have to do? It has to come up, grab the liquidity above the area to then drop to the downside. And another entry confluence, you could have drawn a fib on this imbalance here. You could have drawn a fib on the whole imbalance area from this whole move down. And if we draw that across, get rid of this so you can see it. Let's get rid of this. And as you see, price grabbed the liquidity, tested the fib, and you would have got the sales. So you got the sales. You could have got, you know, I always say 30 pip stops is pretty much in line with that imbalance as well. Where you've targeted this low down here. So once again, some form of liquidity down here, and you know, perfect target. You've got this imbalance, another tweezer top, which hasn't been tested again. So you've got this one here tested, this one here yet to be tested. So that's where you target. And what's the risk reward? You know, got 1 to 5, not too bad at all. And even after this move up, you could have got another entry, because say you're using all the other things I've taught as well, and not just this, you could have got the entry here. Let's say you've drawn the fib. Wow, 1, 2, 3, 4, 5, 6. Say you're waiting for the 3 tap, you've got the 6 tap in this area. So you've got double the confluences. You know, price has got to come up to fill this imbalance. And even if we draw, you know, this fib across, remember I say it's still valid even after it's gone past the fib. So if we draw this across here, you can see the price came past the fib. People would think, oh, it's invalid, it's invalid. But we just needed to fill the imbalance area. And then price came back up, tested the 0.7, the 61 again, before then creating the next drop. So does anyone have any questions on this so far before we move on to another pair? Right. US 30. All right, so with US 30, it's kind of let's get rid of this actually. It happens a lot on US 30. You see this liquidity grab. I personally look on the 1 hour or the 30-minute. This is where it happens a lot of the time. You see these liquidity areas that are liquidated before creating the big move. Let me find an example. Yeah, so you could say this area here, because you did have this whole area of liquidity. You know, we had the move up, price again stuck in this area, stuck holding the area. This is acting again as a retail resistance area. So we know that price has to liquidate all the people selling at this area to then create the initial move. Because I remember what I said in the previous Zooms, what does the bankers have to do? They have to move price up into this premium zone up here to then move price down to get their clients in at a higher price to then short it down, making them and their clients more profit. So their clients will go back to the same bank to do more business because they're making loads of money. So this move up is actually using their own liquidity. And it's also stopping out all these people selling at this so-called resistance area. And what you'll see is a lot of the times when this happens, it's also getting the fib entry here. So if we remove the 38, because it's not really relevant for this, yeah, that'll do. So what do we have? We have the imbalance area, which is being created. Then we've got consolidation. Remember I said after a big move, you get this consolidation phase. And in this consolidation whole area, you've got this so-called resistance area. So we know the price has got to fill more of the imbalance, which is done by this push. We know that there's stop losses above this area because people are selling here. And we also know that once price comes up to grab this liquidity and also fills the fib level on the imbalance, you know, we've got our three confluences. And when we've got this tweeze top, we've got another confluence. And, you know, on US 30, when it moves, it moves. So to be safe on US 30, you could have had your stops above that wick there. It's not the best, you know, 345 pip stop. I usually try for like 200 pips maybe for tight entries. But if you want to be like super, super safe, you could have had it above this whole imbalance here, but I personally wouldn't have done that. Because, you know, with US 30, if price does create this big move up, it's likely to carry on. Because, you know, when you have these sells, it carries on in the same direction for a while. And then you have create a bottom and then we reverse back. But if you see long-term on US 30, we just go up. So that's why you got to be kind of wary in actually shorting it. But if you actually see here, targets, many areas to target. You could target this area of wicks here. You could target this imbalance fill here. That'd be a good target to have. You know, you could target this area here, but this imbalance and order block, I guess, it's already just been filled. So you wouldn't really have been targeting there. But say you targeted this area here, you know, you've got pretty much a 1 to 10. And on a 100K account, you just made 10 grand. You're loving life. You know, you one or two trades like this a month on a funded account and you're sorted, like properly sorted. So that's why I don't really aim to take many trades. Like you probably see, I don't really enter many trades. I feel like last week I entered quite a few and it's like 4 or 5 trades. And that's a lot for me. But does everyone understand how price creates the so-called resistance liquidity area and then comes up to grab it before then pushing price down? Does everyone understand this? Before? Yeah. All right. So, God, I think people wanted me to go over my gold trades from the last week, so I'll do that now. Let me just delete this other stuff that we don't need. All right, so yeah, so that one was the one we talked about. So I think I went over this one, how we had the liquidity grab. This one here was, let me see, what time was this? Yeah, so a lot of the times you'll see, remember I said 1:30, this is when you get the manipulation. So at this whole time here, we had this consolidation. So let's go down on the time frames and let's have a look at this area. So in this area here, whole area of liquidity, well, technically this whole area down here was liquidity being created. And then remember I said 1:30 is when you get the manipulation. So here, 1:30 open, manipulation down, people trying to get into sells. What does price then do? Comes back up, grabs the liquidity from here, grabs it, some sort of a tweezer top here. I got the entry of a sell limit, and then boom, melted. Let me see if there's any other conferences. So on the 30-minute also, what you've got is this order block. So this order block here, if we now go down, go back. So yeah, this order block was in line perfectly with the tweezer top. And if you missed this original entry, price came back, tested it on this this imbalance which it left, and then dropped. And target, why did I target there? If we look back, wait, let me see. Oh yeah, 1800. On gold, 1800 key level. 1800. You have 1825, 1850, 1875, 1900 key levels on gold where price reacts from. You also have, I think now the area where we could see some resistance. You have, where is it? You have 1775, which obviously is quite a way away. But as you see, 1775, all this liquidity in this area. So price came down, tapped in 1775, 1775, 1775, this whole area here. And then where did we come to? 1800. And look what happened in 1800. If we put a little mark here, 1800 level, wicks, another liquidity grab of this 1800 level, drop, came back, tested 1800, drop, came back, tested 1800, broke through from the news, liquidity created, grabbed the liquidity, back down below 1800, came back to test it pretty much to the pip as well. Same thing here, liquidity created, you got multiple wicks acting as a resistance zone. And then we have the grab, tweezer top in here, retest of the zone, boom, drop. So with this liquidity, you can use it as an extra confluence because you see a lot of the times you have an imbalance to the left. So this example here, you've got this zone here, you've got an imbalance. You've got an imbalance. A lot of these areas, I think it had on US 30 as well, you usually have an imbalance candle to the left. We have the big move down, and obviously when you have an imbalance, that is usually a big move, leaves behind an order block. And then what does price do? It has to retest the imbalance area. This one probably wouldn't have actually filled 61. Yeah. So this one was, you could say like a 50% fill. But I wouldn't have entered on the fill on this one. You could have literally entered on the liquidity grab where prices grabbed all the stop losses, created tweezer top, drop. And then target, you could have had wick here, wick fill. You could have literally had this whole area down here of liquidity. So this whole area like this is liquidity. And what did price do? Wick down below, grab the liquidity, big push up. So a lot of the times, these happen quite quickly as well. So like we have had here, grab the liquidity, next candle, big drop. We grab the liquidity, same candle, big push up. Here, grab the liquidity, same candle, drop down, next candle, big push. So this is why I personally use buy and sell limits, because you can miss these trades if you're too late to them. But I think this one was a sell limit as well. I sent a signal as a sell limit. But you've got to be careful with sell limits as well, because you've got to account for your broker spread. So say I was looking at 18.15 for this sell limit. If you go on to this broker here, so Oanda, it came to 18.15.1. If you go on FXCM, it came to 18.14.95. So your broker spread was the same as FXCM, you wouldn't have been tagged in. So it's best to maybe put it like 2 pips, 3 pips underneath, maybe, depending on the spread, to be sure you get tagged in before the move actually happens. You don't want to do the analysis, make the move, and your spread from your broker doesn't tap you in, because that's like the worst feeling ever. And you've missed a trade because of your broker spread. But also, you've got to be careful with your stop loss. Say you're using tight stop losses, maybe like 2 or 3 pips. Account for your spread. So say you're using 2 pip stop and you have a 1 pip spread, put your stop loss at 3 pips, because you don't want to be stopped out, not accounting for your spread when price never actually touched that area, because that happens a few times for me personally. But if you're trading like EU, I think it has 0 spreads on most brokers. A lot of major pairs, you're pretty much sorted. But has anyone got any questions on this liquidity? All right. I'll find one more example of this, and then we'll call it a day. Let me see. Has anyone got any pairs actually they want me to do it on the day trade?
Did you do GJ?
All right, perfect. GJ. Technically, this area here is the liquidity grab, because you've got this liquidity here, and this area was the grab. So remember I said you get this slow moving price, and you see here all slow moving price, slow price in this area. So say you get an area like this. This isn't really liquidity, because prices came into the area and it's out of it straight away. But you see an area like this where you've got wicks all into the same area. This is when you can see price grab it, because when prices like this, people think, oh, it's holding the area so well, so they're looking to sell. Stop loss above, price comes up, grabs the liquidity with this sweeping motion, grab it, tweeze the tops again, drop, target where you could have targeted this liquidity here. You got this whole build up here. You got wicks going mental, and yeah, pretty much perfect. Draw it back down this area. Pretty much perfect. And you also could say, wait, let me try and get this all on one screen. There, look. So we had this liquidity area back here. Never was grabbed. What did price do? After all of this, you've probably caught the buys, you probably caught the sells up here down. Price came back to fill the liquidity from the 30th of August. Look, grab liquidity, gone. So, don't neglect areas from a while back, because you can miss certain things. You'll probably be in a trade, you'll be selling. Maybe you re-entered here, you're selling down. You're like, well, why did price reverse again on me? I was in such nice profit. Then you zoom out and realize, it's got unfinished business back here. This liquidity hasn't been grabbed yet. So what did price do? Create this big drop, grab the liquidity, and then we reverse straight away. And this literally happens on every pair all the time. You could even go on like a 7-minute, 5-minute time frame, and you could see this happening all the time. So like the same thing here. You have the liquidity, wicks. Price came up, grabbed the liquidity here, dropped down. You could say the same thing here. You got liquidity, grab, came back up. And yeah, this is a very, very consistent way of trading as well. Because say you pair it with all the other things I've taught you. So you like I showed you an example, you've got the fib and the imbalance as well. You could tap into an order block. And yeah, if you pair it all together, you'll make a lot of money trading because you only need 1 or 2 trades a week and you'll be sorted, especially with like the risk rewards that you can get on these. So say you entered here, your stops above this level here, target this area down here. You know, you've got 1 to 17. And let's say you then bought on this liquidity grab here when price grabbed it, tight stops below. You're targeting this order block here, 1 to 16, 1 to 17. What's that like? 1 to 34, 1 to 33. Captured 2 trades, you're done for the week or even done for the month, depending on your account size. So yeah, make sure your stop loss is tight because on these liquidity grabs, it will often be against the trend because you'll see price here is in this uptrend, but you can see price is grabbed the liquidity and you want to be out of the trade quickly if you're wrong. So say price breaks above, carries on up, back down maybe, back up. You don't want to be in this trade holding out, hoping that it drops still. You want to know if it breaks this high, it wasn't a liquidity grab, I want to be out of the trade quickly. So that's why you got a tight stop and a big take profit. You could have even scaled down and got even tighter stop at this top area here. So if we look, yeah, you could have even pretty much got an entry on any of these wicks up here. And then your risk reward would have been like a 1 to 39. So it's almost over doubled just by refining your entries. I say a lot of time, use 1 time frame, but that's with like imbalance, fibs, stuff like that. Use 1 time frame because you're drawing a imbalance area on the 4 hour, but then you're going down on the 1 hour to draw a fib, but that isn't the same imbalance area on the 1 hour as it was on the 4 hour. So with each of the things I teach, they have like different rules. So with this, you could have the imbalance fib lines up perfectly with this liquidity zone, liquidity grab, go down lower time frame and enter on the liquidity grab on the lower time frame in that imbalance fib area. Because say you get 3 taps on the 1 hour on a fib, that means price has been in that 1 fib area for 3 hours. So you know that on the lower time frame, you've got some sort of Wyckoff in that area. You know, you've got that distribution, you've got that accumulation or reaccumulation even in this area before price then begins to switch directions or even carry on the direction which it was trading in. So I hope this Zoom did help. I might go over Wyckoff in one of them, but just put it in the Discord if you do want to see Wyckoff because it's quite complicated and I don't use it personally, so I don't know if I should teach or not, because I know it will confuse a lot of people. But yeah, I hope this Zoom did help. If anyone's got any last questions before I go, then ask them now.
Do you personally use the 30-minute chats to trade with, or
yeah,
go higher?
I only use these 4. So 7-minute, 30-minute, 4 hour and daily. It's pretty much it. 7-minute, hardly ever. Say I'm scalping, that's what I use. 4 hour, pretty much the best time frame ever. It's just, you know, you can trade perfectly on the 4 hour. Gold, I like to use the 30-minute because on the 4 hour on gold, it's just a lot of wicks. So that's why I use the 30 minutes. It's just a lot cleaner. And then the daily, obviously the daily is the daily. You can see a lot direction, a lot on the daily. So that's why I use that. And the 7-minute, you can literally just scalp a bit. It's quite fun. Yeah, that's timeframes I use. Any other questions before I go? Was good?
Yeah, I'm good.
All right, perfect. If you have any other questions, just leave them in the Discord and I'll upload this Zoom after we're done. I hope it helped and I'll see you next week.
Cheers.
See you in a bit.
Hi,
Thank you.
Will.
Bye.
Sorry.
Hello.
Hi, Will.
Have you got a question?
Yeah, just a quick one.
Yep.
Last week you did pretty much a question and answering session.
Yep.
I haven't seen it uploaded. Were you intending to do that?
Have I not done it?
I didn't see it.
Let me have a look. I don't think it was called that. I think it was called something else.
I think you did it as let's have a look.
Let me have a look. Mentorship.
Is it not QML backtesting in questions? It's not that one, or examples in general overview.
Yeah, I think
That was the
it
one
was.
before.
I think it was the QML backtesting and questions one.
Okay, I'll just double check because last week's one was quite short. Was it last week, possibly? Or maybe the week before.
the
It was
last
maybe the week
week's-
before, actually.
I think the questions one was like 3 Zooms ago. I don't think it was last week. I think
Okay, I knew there was a quick session. Where
I think it
kind of-
might have been that one
Yeah,
Okay.
QML backtesting in questions.
because I think a lot of people had questions on the things I'd already taught, so I wanted to go over that before moving on.
Okay, cool. Cheers.
But yeah, is that all good?
Yeah, cool.
All right, perfect. I'll see you guys next week.
Cheers. Bye.
See ya.
Cheers.